Hilton brings you new ways to stay, with experiences that let you capture the glory days. Introducing the Graduate Hotels. Each inspired by local college towns, these stays are always original and never boring. Get in touch with traditions all across the country and enjoy a stay that's a class above the rest. Book at Graduate Hotels with Hilton Honors Points at Hilton.com. It's a win-win. Hilton, for the stay.
Reality radio for a really great future. We're talking real money.
Do you know how that there's a company who shall remain nameless that talks about the metaverse? This is the Metacast. We are all casts all the time. We are virtual casts. We are real casts. We are video casts. We are audio casts. We are casting to you. We're casting a line. I knew I'd have another one. And we're going to talk. We're going to cast you a lifeline in terms of helping you better understand money and deal with the stupidity that is the financial markets. And oh, Lord, the stupidity out there is legion. Hello, everyone. Welcome to the cast. I am Don McDonald. Joining me on the cast, our other cast member, Thomas C. Cock, hanging out in the aircraft hangar.
Hello.
That's all he has to say today. That's pretty much the extent of his entire thought process for the day.
My repertoire is done.
My
Thank you.
repertoire. Hi, everybody. It's so good to see all of you. I want to apologize for the neatness of my hair.
Yeah, you look kind of official, spiffy.
The reason is I've spent the last couple of days playing a part in a student-made film for a film-making program at a university here in Central Florida.
My daughter wanted to know when that's going to be available for viewing.
I think they said that they were going to finish. He has to present it in like June for his master's thesis. So I was in a movie. I just wrapped up shooting. It was really nice. The kids are nice. What they do at the end of shooting is they go, "That's a wrap," or that's a show wrap for Don. You know, when I got to the end of everything I do, and the entire crew applauds.
Wow.
Which is all I get. There is no money involved.
I thought they were buying you something in Bitcoin and putting that in your wallet.
No Fidelity Bitcoin for me.
Okay.
Nope.
Well, congratulations.
No.
That's a big deal.
It's fun. It's just fun. It was all night because they did it at a seedy, I mean, really seedy dive bar billiard parlor. I mean, it's the kind of place you go, oh man, I have to hose this floor off every night, I bet, or every morning. It was quite the spot.
Those were the days.
But we didn't hit it, of course, on the busy night. So anyway, welcome to Talking Real Money. Don here, Tom there. Today we want to talk about the color red. Oh, Elmo loved color red. No, not the color red as in your statements, as in those screens you look at when you go look at the stock market, as in every part of the financial markets lately, pretty much. Is there anything that's up, Tom?
Not year to date. No, that I know of. Actually, not even one asset class is up at all. Period. So yeah, people have gotten their first quarter statements. That is an all red day.
Year.
It is very red. In no way should this be construed as a political statement. So no, I mean, and the reason that I want to talk about this is a few of you are calling concerned. A few of you are worried.
That's normal. That's why we exist, though, by the way.
Exactly.
It is for moments like these. We live for moments like this to help you stay the course.
Yeah. So, and I took the liberty last night of looking at the year-to-date return of a portfolio, 60% in stocks, 40% in bonds, globally diversified, and you're down 6.1%. Now, I did have someone call me, a gentleman called me yesterday. He's got about $1 million portfolio. And he said, hey, I'm pretty nervous because since the beginning of the year, I've lost $60,000. I thought, well, actually, that's a better perspective than a percentage, right? Because a percentage that's a number. The actual money out of your account, well, that's a different matter. Yeah, I get it, that's troubling. So I talked him through it. But let's talk through it just a little bit. And we've touched on some of these things before. They're not radical, but they I think they need to be said many times. Number one, if you instead don't want to have any volatility in your portfolio, then you put it in a savings account, right? Because there's really nothing moving up or down there. The challenge is you really don't make much in a savings account for that reason. You're not taking any risk with your capital.
You make less than not much.
Yeah.
You make negative after the inflation we're having today.
Way negative.
And by the way, though it's been said many times, many ways, you're making a great point today.
Thank you. I appreciate that.
Well, did you get the Christmas reference?
That's very good. Yeah, I really appreciate it. You're really on a roll. I think it's the movie thing. So the short-term pain for long-term gain. That's the trade-off that you've had to endure. That's part of the deal. Number two, this is not a big, huge bear market, even though there are some headlines saying that. I know we're in kind of correction territory on some indexes, but if this is really troubling, to see your portfolio down by $60,000 if you have $1 million, I urge you to go back and look at what happened not that far back, 2020 or 2008 or even 2000, because you need to know how bad it really could be. Because this is not that bad. You could be, so if you're in a portfolio that you're troubling you today, what I'm trying to say is maybe you shouldn't be in that portfolio, because we're not timers. But I am a believer in you need to know your own personal risk tolerance, your ability to take the ups and downs. And that's why Don found out, spent hundreds of hours trying to find the right risk quiz. The risk quiz is a great instrument. It's a great tool to know yourself about money, because you need to know. The adage is Wall Street's an expensive place to get a lesson if you don't know, which brings me to number three.
And before you get to the third point, I want to reiterate this. It needs to be said many times, many ways. There's very little in this business of investing that is more important than you knowing you. You need to know you, how you will react in the future, because that is the price you're paying for the potential, and so far, a century or more than a century of making decent money. But you have to lose some once in a while.
Yeah.
Otherwise, you won't make some. But you got to know how much you can tolerate before you do something stupid. Now on to reason number three.
Well, I think reason number three is a lot of the reason that we're here today discussing it, and that is the following. There is so much noise out there. I mean, everywhere you turn, people are talking about what's going on with stocks, be it the radio, be it television, be it print, be it web, wherever. It's always there. It's always on you. You have to learn how to tune out that noise, because it's not going to go away. It's not going to be, if anything, it's going to get bigger, because the more markets go down, then the bigger story it becomes. Or when they lose 800, the Dow loses 800 in one day, then it becomes this big story that everybody needs to know about. You need to figure out how to ignore that, because every single thing we know says the people that can't end up with less. It's a guarantee, because you end up getting out of the market at the wrong time. And that brings me to number four. All of you people that told us at the beginning of the year, and there were a good number of you, who said, mutual funds, ETFs, kind of boring. I'm going to move some of my money in individual stocks. Great companies like, Netflix, et cetera. Technology, because it's been the hot sector. You have gotten creamed. And again, diversify. It's the only free lunch I know on Wall Street. Buying individual stocks, you've seen it again this year. I mean, even fund managers that have limited number of stocks have gotten creamed. See ARK, for example, because
ARK's now down 46% for the year.
Yeah, I mean, that's a pretty big. Now that is a serious decline.
Well, and add to that the 23% from last year.
Gets to be a little steep. But don't worry, she says she's going to make 50% a year for you for the next 5 years. Sure. So not to be concerned.
They'll promise you anything.
Exactly. So there's a surprise. But all the things I just mentioned are very important. I think what you said, Don, is probably central. That know thyself. If you do, and you're able to just say, market's going up, market's going down, that happens every day. I don't pay attention to it. I'm looking at the long haul, and I'm looking at, my goal in mind. you're going to be good. If you're one of those people that's going to look at it all the time, look at your balances, pay attention to what the experts are saying, you're going to have a hard time with this. No question.
And what you need to do, a couple of things you need to do. You need to avoid, because Tom mentioned this, there's so much noise out there. If a headline splashes up on your newsreader service that says something like this from one of our favorite publications.
Yeah.
He said facetiously, "These money and investing tips can be keys to success when stock and bond markets fail." Who do you think that's from? Who would you guess that headline is from?
Is it Barron's? Is it
Nope.
Motley Fool?
No, you're close. You're close. Paul writes for him.
Market Watch?
Market Watch.
Yeah.
Yes.
They
How
want you to
investors
pay
can
for that
cope.
nonsense.
Yeah, I'm not paying for their nonsense. But
No.
here's the thing. One, don't read those articles. Read articles on the science of investing, on knowing yourself, on behavioral finance, better ways you can control your emotions, how to understand your risk, how to plan, how to create a plan for the future you both need and want. Those are actually two different things. You got to
Yeah,
make sure you
they
can cover the need. Maybe you can get to the want and how much risk you can stand getting there. And then finally, this is 2 words of advice, 2 lousy little words, and they're not mine. They came to me. I had them spoken into my ears and yours by one of the more brilliant people to ever work in the financial services industry, a guy by the name of Jack Bogle. And he said, when we're in a market like this, you know it's down, you hear it on the radio, it's abstract as long as you're hearing it on the radio or hearing it from us. It's really abstract. It doesn't hit home until you open your statement or you go online to your brokerage account and peek. His advice to you, don't peek at your portfolio, because when you see your portfolio going down, that's personal.
Yeah, percentages don't mean much then. It's really the actual dollars. I think that, and I think that's a fair point. So, yeah, all those things. We know that all of the people that can't put it away, can't hide themselves from all the news, just end up with less money. It's a basic fact. They end up trading their way out of markets.
I want to add something personal to this too. I have been doing a financial talk show with hundreds of thousands of people listening all over the country over the time for 35 years. It's a long time. And I find that even when I go to my Schwab statement, I type in schwab.com and put in my password, and that number comes up on the screen, I get butterflies. I get nervous. I get anxious. And I know better. I know this. I intellectually totally get it. And yet I still feel that emotional pain when I've lost 5 figures. I haven't lost 6 yet. That'll be more pain, but I'm not looking.
Yeah.
It hurts.
It does. And that's a good point. So again, our advice is have the right portfolio and know yourself, and the rest of it,
know thyself,
and have the plan and the plan, not the plane.
The plane.
The plan.
We are going to do one more question.
Yeah, we got time
today.
for one more. Yeah,
just one. Well, one.
Okay.
We did a couple yesterday. This is just one for today. We are into April, so we're doing okay. We're not caught up.
Good.
But
we're coming back.
Okay, this one. It's a little technical, but you can do this, Tom.
Okay.
My question is about multiple accounts. I think there's some confusion about accounts. Well, we'll get to that in a minute. I have looked through the samples you have online, and they do help give me an idea of the breakdown of assets we should have. My problem is that my wife and I both have multiple accounts, and at this time, we cannot combine them to make allocation easier. I have 2 different 403B accounts because I currently have 2 jobs. I also have a Roth IRA with Vanguard. My wife has a 403B account with one of the same companies I work for. On top of that, she has a Roth IRA and a rollover IRA from a previous employer. Both of these accounts are through Vanguard. Are there any online calculators or resources that help manage so many different accounts as if they were all one?
Yeah, I'm going to say no, there isn't. But I will also say this. I don't understand why you would have two 403B accounts for one.
He has two employers.
Working for two different people. Oh, interesting.
Yes.
Okay. Wow.
So he's active in two 403Bs.
Okay, but there's a couple of basic.
His wife is active in one 403B.
All right,
so
and I got that.
We got 403Bs. We've got IRAs.
No, one IRA, I think they said. And two Roths.
He has a Roth with Vanguard, and she has a Roth and a rollover with Vanguard.
Yeah.
So right now, what we have,
IRA? Two Roths, one IRA.
Well, a Roth is an IRA. Still.
But just because we're going to get into the specifics about where to own things. Yeah.
The reality is all of these accounts are tax advantaged. So that eliminates which asset should I keep.
That's a good point.
Taxable account and which in a tax advantage. And in reality, I think what it boils down to, Tom, more than anything, this is the question: what's available where? I think that's
very true. That is very true. And generally in the 403Bs, you're not going to have the best asset allocation available. I mean, it's simply, you're not going to be able to buy many value stocks. The small cap you buy, not going to be that small. So you might look to the Roths first because those are self-managed. You could use anything there. And the Roths, again, grow tax-free versus the IRA and the 403Bs. Those grow tax advantage, but not tax-free. So I would probably look at the Roths to have the more the asset classes that you really want to supercharge your portfolio. So
you're talking about
value.
in the Roths to have things like small cap value, emerging markets, that kind of
stuff like that, and then you build around that. In other words, the first thing would be to decide, okay, we want our global asset allocation to be
50-50.
Whatever it is, 50-50. Okay, now we get, those are two numbers. That's going to be a certain amount in stocks, certain amount in bonds. Okay, of that.
We got bonds and stocks. I thought you said U.S. International. You're talking about stock bond.
Yeah.
So stock bond, whatever your age is, 60-40, 80-20, 70-30.
Okay.
Yeah, okay.
Then you just take the gross number times 60, and you say, I'm going to have blank number amount of money in stocks. Okay. So I would then start with putting all of my stocks in the Roths because you hope for a home run there. Grows faster, right?
Mm-hmm.
Okay. I thought you were shaking your head. No.
I'm just thinking about it for a minute because we got 403s where the reality is they're not likely to they're likely to have, in many cases, not the best funds when it comes to anything other than large cap U.S. stocks. And even with bonds, they may not have the short intermediate kind of bonds that we're looking for. So it may end up that those 403Bs become, just by default, they end up becoming your large cap U.S. and large cap international holdings and all of the peripheral stuff because you may not be able to get it. For example, they may have a PIMCO bond fund in the 403 at a high fee where you can get something from Vanguard a lot cheaper in your IRAs, rollover or Roth, but probably in the rollover for the bonds, right?
So this is a bit speculative, as you point out. So we don't know the particulars. And generally, again, if you're saving into the 403Bs, you're able to save more there than you would be in the Roth. So you're right. So some of the core investments, the core bonds may be there, as you said, or the core stocks, U.S. large, et cetera. That could be in some of those 403Bs, and then build out from that in the Roth and in the IRA that you can self-manage as well. So again, you're right, Don, but some of it's going to depend on sort of what is in those places. In other words, the 403Bs, you're right, will determine that asset allocation because there's only so much available. Then you can build the rest of it around it in the Roths and the IRA. That's how I'd look at it.
And here's an idea. Again, this is not a plug. It sounds like a plug, but it's not a plug. Go to Vestory.com and set up an appointment with one of our advisors, and they can kind of help you figure out what might fit there based on what's available. And they'll do that. We do it for anybody who wants for free. We don't try to pitch you anything. Just set up an appointment with an advisor and say, because we can't manage those monies anyway. Most of them, we can manage the IRAs, but not the 403Bs. Get a little advice on getting those properly allocated. It can really, really help. And it doesn't cost anything to meet with one of our advisors for a little while. And you won't get a sales pitch. Okay? Promise. Right? Do you want to promise too? Weren't you a Boy Scout?
Absolutely promise. Oh, you're going to make me do the
Can
Boy
you
Scout
do your Boy
oath?
Scout thing?
I hereby salute.
No, it's fine.
okay,
Never mind.
Okay.
God bless the boy. No.
I wasn't a Boy Scout. I'm an Eagle Scout.
You were a Boy Scout. You had to be a Boy Scout to become an Eagle Scout.
Okay.
You don't just jump right to Eagle.
No, it took 3-4 weeks.
Even you don't jump right to Eagle.
Okay.
But ladies and gentlemen,
Yeah.
if you'd like to meet the Tom of your dreams,
Oh gosh.
the Eagle of your dreams, the
Is landing?
eagle-eyed Thomas C. Cock. Wait a minute, that's a chicken. You're no eagle, you're a chicken.
That really hurts.
You can meet him at Retire Meeting.
Yeah, that's true.
where you meet Tom. It's a retire. Wait a minute. It's not about you.
Oh,
It's
sorry.
about retirement. You made me think it was all about you.
Yeah, it's not. It's not about me. It's not about you. We have tons of, by the way, far more gifted speakers than even Don. Paul Lupescu,
and
pretty
we
good.
taunt them mercilessly too.
Paul
It's gonna be
Merriman,
fun.
pretty
Paul
good.
Merriman,
So
we taunt
you
all
can
the
join
time.
us. Oh yeah, somebody even I called them. They're like, "Oh, poor Paul." So again, join us Saturday, May 14th.
They don't know Paul that well, do they?
No, they don't.
He
They
can
don't.
give as good as he gets.
That's for sure. So yeah, I mean, it's as simple as signing up either virtually or in person in Bellevue. We'd love to see you, and it's going to be a lot of fun. But you're going to learn a whole lot. So Retire Meet Saturday, May 14th. Join us.
Yes, indeedy. You're going to learn a
about that?
whole lot at our Retire Meet get together there in Bellevue, Washington. What was it? You learn? What'd you become? Countrified? I'm going to learn
live in the country.
whole lot. Oh, that's true. You do live out in farm country there.
I do. Yeah.
Yeah, bear country. He's got the big bear
Banj-
safari out in the front
the
yard.
Banjos are playing, as we like to say. So got that going.
Banjos and bears on the front porch. You got the bear rocking in the rocker there.
You're standing
Welcome to
between me and
Tom's
my
house.
tuna fish sandwich, so this better be
I'm
good.
Billy Bear waiting for the fish. And we'll let
Comforting.
Tom go eat a sandwich. Thanks for watching, listening, joining us. Subscribe, tell your friends, share us on social media. You can share Tom as often as you want on social media. Just pass him around. And leave a review if you like what you hear. Watch us on YouTube. Subscribe on YouTube. You know, there's all quick interjection. I watch occasionally YouTube videos, and they all go, and I don't even know where these things are. Ring the bell, hit the subscribe button, and they're pointing to things. And I'm looking around going, where are you pointing?
Where's the bell?
Where's the bell? I don't see a bell. Ring the bell. Did you like get a big tip at the bar? Bing. Oh, I just tipped him. So do whatever those things are they tell you to do on YouTube. We don't understand this stuff that well. No. So say bye, Tom.
Goodbye, Tom.
Goodbye, Don. It's nice knowing you.
Good night.
We're hanging out, talking real money.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.